Welcome back, friends, in the module of financial management. So today we are going to learn very important aspect of financial management, that's understanding the financial statement. The first financial statement which we have is called income statement. So what is income statement? Is it going to concern about all the incomes? No, it is also include the expense. So basically it's showing me net income which I have earned over a period of time. That is what we say financial statement number one, income statement, give you as on, not, it is not giving you as on, it is giving you profit for a period, income earned for a period. That is what is very important to understand, that profits and incomes are calculated for a period. So it may be last year you have earned profit, this year you may be earning losses. Friends, we need to understand the difference between net surplus cash which we was gaining in cash budget, was it showing a profit or loss, or is it something different? Friends, that was not a profit or loss which was earned by a business. That's only surplus cash which you have with you, or any kind of shortage of cash which you are having with you. Cash surplus and cash shortage is not related with the profit and loss. Profit and loss is something which is earned over a period of time by the organization by doing economic activities in terms of selling the products, services, and incurring expenditure to do that, to achieve that thing. So how we should prepare the profit and loss statement or income statement? This is the both names for the same thing. And even in the not for profit organization, they name it as an income statement also, because they don't make any kind of profit and loss, but they make surplus or deficit in their incomes which they have. So for understanding how we should make the profit and loss statement or the income statement, we need to understand some basic concepts of accounting. That, as I said in the very beginning, that is the language of the finance guys. So for understanding that, we need to go to some basics of fundamentals related to the, again, accounting and finance. The first principle which we need to understand is double entry system. So double entry system says that every transaction has a double impact, means twofold impacts are there for every transaction which is happening in the organization. Now let's take when owner invests money in the organization, what happened with that? When owner invests in money in the business, money comes to your bank account, that money has come in, that financial transaction happened, that bank account balance has increased, but at the same time you have a liability towards the owner now, because this is another concept is there, that you and your owner is separate. So business is a separate legal entity, so it means you have to pay back that much money to your owner, so that becomes a liability to you. Similarly, if I am going to buy in some asset is now from that money which has been invested by the owner. So if I am buying equipment, so let's say I am buying a computer, so it means computer and asset has come to my organization. That's the first aspect. And the second aspect of the same transaction is my bank balance has been reduced if I paid the money in cash. Or if I have not paid in the cash, I have bought onto the credit. So that means there is a liability has been created further which I need to pay. So that two transactions which always will be happening. Let's say, take another example, when you are going to pay to your employees the salaries, so that salary is an expense which you have created. That's the first aspect which happened, and second aspect is your bank balances has been reduced. So this is how every transaction has a double impact. That is what the concept of double entry system. Friends, you have heard many times this term debit and credit. What is debit and what is credit? These are the two just acronyms which are being used in the field of accounting. They are not carrying any kind of meanings. It's a usage of debit and credit at different times differ. So that's why never ever think that bank debit means there is a decrease, or credit means there is an increase. That doesn't mean in any ways. So understanding debit and credit, we need to understand in accounting we keep 5 types of accounts in journal. So 5 broad categories of accounts are I put in a very easy way to understand. You remember in your childhood a story of Alice in the Wonderland. So we will keep the word Alice with us. This Alice is really giving you that we have 5 types of accounts. A stands for assets. So you have assets with you, and then L stand for liabilities. Every organization will have some assets, some liabilities are there. Then I stand for income, which is income is going to be there in the organization, and C stand for capital, which is there in the organization, and E stand for expenditure or expenses which are being done in the organization. Friends, A is assets. Always asset accounts will always have a debit balance. Then we have a liabilities. Liabilities will always have, because liabilities are reversed to the assets, so they always have a credit balance. Same way, my incomes will always have a credit balance, and my expenses will always have a debit balance. And capital is again a liability of the organization towards the owner, that is also have a credit balance. So these 5 things which you remember, LIC, that's Life Insurance Corporation, is your credit balance, and your A and E, that is in the Alice, is something your debit balance. Friends, one thing is very important, your all debits will always have a equal to the credits which is there in organization. That means this is called an accounting equation. Every accounting equation start with, the accounting equation starts simply says total assets will be always equal to total liabilities of the organization. That is what is a base, or in other words, total assets are always equal to the capital and the liability of the organization, other liabilities other than owner's liability. That, so you can say A is equal to C plus L, or if I further add into it, A plus income, A plus expenditure which we have is going to be making my profit and loss statements in my organization. With this understanding of double entry system of accounting and types of various accounts, why we were discussing these things, because we want to, before preparing an income statement, we will prepare a statement which is called trial balance in the organization. What is trial balance? Trial balance is a summary of all accounts which are being there in the organization, whether my assets, whether my liabilities. So trial balance is a statement which we make in the trial balance, which represent all the accounts which we have, which were having a debit as well as the credit balances. So as I said, all assets will be having a debit balance in the trial balance, as all expenses will also have a debit balance in my trial balance. My income, my capital, and my any kind of liability will have a credit balance in the trial balance. Let's understand now that this particular trial balance will help us to prepare our income statement. Now, for preparing income statement, let me give you first some examples related to this Alice. That what are various assets in the organization? Assets are basically your all kind of computers, all machineries which you are buying, or building you are buying, that is your assets. All expenses which we are doing, paying salaries, paying rent, electricity bills, these are all my expenses which we have. Liabilities of the organization are basically you have taken some loan, or you have yet not paid your expenses, these are your liabilities, or you have purchased some goods on credit, so you have to pay that bills, so that is again a liability to the organization. And if any time you are having some incomes in the organization happen in the form of when you are selling the goods, the money which you are receiving on the sales, that is your income. Or if you have invested some money in shares or something like that, or invested in the bank balance, you are getting some interest over it, that's also income to your organization. And expenses we already have mentioned, and capital is money which has been invested by the owner. So by this we are able to understand how various factors which are there we keep in the mind for making a trial balance, which will lead us to prepare an income statement.